Hi, everyone. Thank you so much for joining this webinar. For me personally, I enjoy interacting with our subscribers, with all of you. My team, our company depends on your support for us to grow. So we value you immensely, and we're really glad you're joining us today. And today the webinar is on what's been happening with markets and what's been happening with gold and what could likely happen going ahead. So I will run you through some of the things that are underlying and that have been defining the movements that has been happening over the last year and in recent years. And then I will take your questions. I have a presentation that may uh, take probably half an hour. If it gets extended, I don't mind extending the session to hear out all your questions. So I'll start with the slides first. We'll just move on to the slides. Yeah, so just give me a minute. Let me just set it up. So, yeah. So first, I'm going to run you through equities, okay? So if you see in the last 1 year, this is what has happened in the markets. Markets have been largely flattish. The Nifty 50 is up by around 6%, and this too because the last 1 week has been good. If you go back before that, largely it's been, you look at rolling returns on a 1 year basis over the last few months, it's largely been flattish, like -1%, +1%. The mid cap is up around, small cap index, which has done very well in the last 5 years, has struggled over the last 1 year, and it's up now, but still close to 8-9%, which is the BSE small cap index is down close to 8 to 9% from its all-time highs in September 2024. So obviously, it's not been a great time for markets. It's not been too bad also. I mean, there are times when markets are down for 10, 15, 20% over a year, 50% over a year. So this is not bad, but it's not great, especially for investors who entered over the last couple of years or something like that. So let us first understand why this is happening. Okay, so let's go back to pre-COVID period, which is FY19. So look at how things have trended. Okay, if Nifty's total, I've indexed the numbers to 100 here so that we'll get a more clear perspective in terms of percentages, etc. So if Nifty's total market cap was 100 in FY19, that is March 31, 2019, today it's 257. So in a little bit, in around 6.5 years, 6.5 years, you've got around over 150% returns if you are invested in markets then, which is quite decent. It's a CAGR of 15.5% or so. But look at the other things. Revenues. The revenues of companies during this time has grown by 91%. If it was 100 in 2019, as of now, the trailing 12-month number is 191. Okay, you can look at the FY25 numbers also, so which is a 6-year period. I've taken trailing 12 months, which is a 6.5-year period. Both are roughly the same. And so if you can see that revenues have grown by 80 to 90%, while market cap has increased by 150%. EBITDA is up by 90%. Profits, net profits are up by a significant 180%, right? So you can say that markets have largely tracked earnings. You can justify the rise of the last 6 years by saying that earnings have grown 180%. Stocks have increased by 180%. The correlation has been good. But now let's look what underlies this change. There is a top level change. Then there is the macro level change. Then there are the micro changes. So let's get to some of the micro changes. Before I get to that, I want to show one more thing at a macro level. Look at this is Nifty 50 numbers excluding financials. Okay. So in the previous slide, you saw Nifty overall. Nifty overall earnings growth equal to market cap growth. This is Nifty 50 excluding financials. In this, if you see, market cap growth is 154%, whereas earnings growth is 126%. So there has been an outperformance of stocks over earnings when it comes to if you look at Nifty excluding financials. So this is one aspect for you to keep note of, and I will be referring back to this again. So now here what we have is in this sorry. So in this slide, what we have is uh, if profit growth was similar to revenue growth in both cases, Nifty excluding Nifty, overall Nifty, and Nifty excluding financials, 61% of your profits has come from revenue growth. The balance 39% has come from margin expansion in the case of Nifty. In the case of Nifty excluding financials, 68% has come from revenue growth, 32% has come from margin expansion. Let me also clarify the data I am taking here is Nifty total market capitalization. What you have in the Nifty index that you see that you track every day is a free float weighted index. In this case, I'm taking the total market cap of Nifty to do a more clear comparison between earnings and the market cap. So, so here is this thing. So, if Nifty had, if there was no margin expansion, okay. So, if you see the orange chart here is what I call it an alternative scenario. If if there was no change in margins between FY19 and till date, and if there was no change in PE ratio, and markets only tracked earnings, okay, how the growth in market cap should have been, or how the Nifty should have grown. As compared to the 15.6% CAGR you've actually got in 6.5 years, you would have got only a 10.5% CAGR. Still not bad. It's quite decent, not much to complain about, but substantially lower than what it would have been. This is one important aspect I want you to keep in mind. I will explain why in a couple of slides, because this matters for the future. The 10.5%, the comparison between the 15.6 number, which is the actual CAGR, and the 10.5%, which is an alternative scenario that I'm talking of, will matter for when you're going to invest for today, looking into the future. As far as Nifty 50 excluding financials is concerned, you have you have a index that would have grown only by 8.7% if not for margin expansion. Okay, so the 10.5, 8.7. So the reason you're seeing this difference between Nifty excluding financials and Nifty overall is that by looking at the difference between the two, you can understand that a good chunk of the profits in the last 6.5 years has been driven by financial companies. Okay, and I'll also come to why that has been the case. So now, look at the margin expansion that has played out in the index. Nifty 50 in FY19 it was 7.5. Okay, today it's 11.1. Right. So you've had a pretty sizable margin expansion. These kind of margin expansions, it might look like 7.5 to 11.1 is 3.4%. I mean 3.6%. Not that great, but it's significant. Okay, these kind of margin expansions don't keep happening, because keep in mind one thing: if companies are profits, margins are increasing, somebody is paying more. Either you as the customer, or the government as the customer, or other corporates as the customer are paying more, and that will impact their savings and their profits. Okay, so keep in mind margin expansion will not sustain endlessly. It will hit a brick wall at some level. So that is something that you'll have to factor here. Looking at that, the margin expansion in Nifty companies has been substantial. Now look at the margin expansion in Nifty excluding financials, 7.8 to 10.3. Okay, so it's lower than the overall Nifty, but still quite decent. Okay, 2.5%. All right. What is the main takeaway here is this. One, the margins have expanded margins, overall Nifty margins expansion indicates overall Nifty margin expansion over Nifty non-financial margin indicates that bank profits have been substantial. Okay, so now why has that happened? FY19 was a period of the country and the banks were still reeling under NPA problem. That has completely been cleaned up since then. Okay, so bank profits have gone up. What are the other factors that have driven the market? Sorry, what are the other factors that have driven margins is corporate tax cuts in 2019. This is one of the most important factors that everyone has to keep in mind, that I believe is not being adequately factored by analysts who are giving rosy targets on Sensex and Nifty for the future. See, the corporate tax cut in 2019, which was announced in September 2019 by the government of India, reduced taxes from around 35%, this is including surcharges, etc., to 25%, including surcharges. Okay, so that alone resulted in if everything was clean, you have a neat 15% bump up in profits. Okay, you have a neat 15% bump up. That works out to a margin expansion of 1.2 to 1.3% when you look at Nifty and Nifty non-financials. Okay, so if looking at the 3%, around 3.5% increase in margins for Nifty and 2.5% increase in margins for Nifty excluding financials, keep in mind around 30 to 40% of that margin expansion has come from corporate tax cuts. It is not going to happen again in the future. All right, that is not going to happen. Fine. So the increase for margins, number one, bank cleanup, corporate tax cuts, GST reforms over the last decade. And I think with the recent GST announcements, largely the rationalization is done. Formalization of the economy. During COVID, what happened was unorganized sector took a hit while formal economies surged ahead. Significant market share gains, digitization. 2015, people wouldn't even pay for 1 GB a month mobile plans. Today, we pay for 2-3 GB a day mobile plans. Okay, it's substantially cheaper. Massive digitization, UPI, digital economy, cost of internet, etc. And so these are the main factors. Okay, so keep in mind profit growth of over 180% for banks, around 130% for Nifty excluding non-financials, is driven by all these factors have played a significant role. Okay, so what is you'll have to keep in mind is that none of the factors that I have mentioned here, you're not going to like no tax cuts, GST rationalization behind is done. Formalization and digitization will continue to happen, but at a substantially slower pace than before. Okay, so when you're looking at when you're looking at profit growth from now, keep this in mind. My view is that henceforth margin expansion is done, and what is going to happen is profits will track earnings. Okay, now to look back at how revenue can grow. Okay, you will have to look at this thing where I've given the data alternative scenario. The orange line basically reflects if profits attract revenue. Okay, so you're going to have it probably, so you can say that over the next 5 years also 8.7% growth can happen in profits for assuming there are no shocks in the global economy. Indian economy is well cushioned, but global environment continues to remain very, very volatile. That risk, I believe, is underappreciated by investors in India. So you're going to have an 8 to 10% profit growth possibly. So that is one factor to note of. If PE multiples don't shrink, you could assume that markets can grow at this rate, 8.7 to 10.5%. But keep this in mind: PE multiples are not cheap. Okay, Nifty PE is today at 23 times. Yes, of course. In FY19, it was at 25 times. If you see that first bar on your screen, uh, but that was a time when the expectations were building up that the worst is behind. Okay, so banks were reporting huge losses. So the Nifty trailing P was high because the forward earnings expectations growth was pretty significant. So the 25 P on a trailing basis was all like a 18, 19 P on the forward basis. Okay, so you're expecting 20-25% annual growth, let's say, when in FY19 market. It didn't play out, but that was the expectation. Today it's 23. Now you're having a 23 P for Nifty when your earnings growth in a good scenario can be anywhere between 8 to 10%. All right. We hope it can be better, but to make a reasonable assumption, this is going to be your earnings growth uh, on a 5-year basis. Okay. See, you might have a sell side analyst who comes and says FY27 earnings can grow 15%. Uh, you can make all those estimates, but on a 5-year basis, these things will trend in line with the macros, and you can expect this is the range that I believe is reasonable to expect. Okay, so 23 times for what is going to grow at 10 times, you're looking at a PEG ratio, which is price to earnings growth of 2.3 times. That's expensive, or at least definitely not cheap. Okay, so that is one factor to keep in mind. For non-financials, the multiples have actually expanded. See, the non-financials is loaded with ITs, FMCGs, etc., which are struggling to grow. Okay, so 25 times uh, a multiple that is more expensive than pre-COVID is very expensive for the non-financial part of Nifty. Fine. So these are factors you'll have to keep in mind. So I believe in the last 1 year, what has been playing out is some of these factors weighing on the markets. So it will continue to weigh on the markets going ahead. So what we now, let's look at what are the headwinds for markets from here. As I said, most of the tailwinds are behind. Valuation, global liquidity likely to tighten. See, I come from a period which is pre 2007 in the markets when 16p was considered expensive, and earning growth at that time was more robust than what it is today. So, what has resulted in this massive multiple expansion in Nifty? You could say so many factors like uh, more people taking up to market. So retail, there is more retail investment. There is more confidence that markets will give good returns over the long period of time. Fundamentals of the economy have substantially improved. The reforms that have been done, especially in the last 10 years, have been substantial. Interest rates are lower. There were times when government bond yields were 9 to 10%, 10-year yields. Today it is 6.4, 6.5%. So the valuation is also a function of what is the alternative option you have. Earlier you had 10% risk-free return. That would compress PE of markets. Today you have 6.5. You can have some expansion. But in my view, one of the biggest factors is global liquidity. And to look at global liquidity, you have to factor this. Okay, one is since 2010 has been those zero interest. 2007 has been ZIRP, or what you call zero interest rate policy regime across global central banks, quantitative easing. So if you see in this particular chart, what I have is the US 10-year yield. Okay, a foreign institutional investor who's looking to invest in India can invest in this, or he can buy a Colgate Palmolive India, or HUL, or or an ITC, etc., or an Asian Paints, right? These are the Asian Paints, HUL are the stocks which were like mid 20s to mid 30s PE that went up to 60, 70 PE valuation couple of years back. They still trade high. In my view, one of the factors that drove this multiple expansion is that foreign investor felt when they were getting 0 to 2-3% risk-free return, a company that gives me that trades at a 50 PE or 60 PE, but will continue to grow their earnings at 10 to 12%, will give me more returns on a 10-year basis. You do the DCF valuation, that is how it will look. Okay, so this was a driver. If you look at this chart, right, look at the second arrow, which is the blue arrow at the bottom. This is a 10-year chart. You can go behind also. US bond yield was always behind 3%, 10-year bond yield, and most of the time substantially below 3%. So there was a hunger for yield among foreign investors. European bond yields were even lower. Japanese bond yields were negative to flat zero. So when you look at all this, there was a massive hunger for yields, and that resulted in PE multiple expansion for some of these uh, 10 to 12% growth companies in India. That is history. People are not appreciating fully the fact that global investors have other options. FIS have been selling for over a year. We keep hearing views that FIS will be back, etc., etc. They will be back on a convincing basis only when our valuations are more attractive, at least relative to the risk-free rate. Okay, I mean, you're getting 4%. If a stock trades at 50 PE, okay, that means its earnings yield is 2%. Assuming there is no earnings growth and that entire earnings is being distributed as dividend, the FII will get 2% every year. Today, the FII gets 4% every year for buying a risk-free bond. And then FIS, when they invest in India, there is currency risk also. So that why will they invest in the 2%? If the 2% yield, that earnings will increase, the 2% yield will actually be 7% by earnings compounding over a 7-8 year period or 10-year period. Okay, so there is a difference when global bonds yield 1% and I buy a 2% earnings yield stock. And it's something else entirely when global bonds are yielding 4% or more, and I am buying a 2% earnings yield stock. So this is one reason why I believe this valuation multiple is kind of, there will be resistance in breaching it. You have to rely only on earnings growth for markets to go up from here, and that earnings growth has less tailwinds than it has. It's still good, right? So our economy is doing pretty fine. You will have decent earnings growth, you'll have decent market growth, assuming no global shocks. But that is what you should expect if you are a long-term investor. Short-term, anything can happen. Okay, like we are at 25 times, so Nifty is at 23 times PE. Japanese took their index to 68 PE in 1989. So if India goes to 68 PE, you can do the multiple and see where Nifty will be. Chinese took it to 55 PE in 2007, but that results in madness, and that results in multiple decades of lost growth in markets. The Japanese went back to the 1989 peaks only 3-4 years back. Okay, so you can imagine how much of pain that madness cost going up to 60, 65 PE. You can see the Chinese are still 30-40% below their that main SSE composite index in 2007. Today it is 30 to 40% below those levels. Okay, so we cannot rely on multiple expansion to 35%, 40%, because that comes with massive risk. And I believe those things won't happen. Investors shouldn't bet on that, because one thing where India stands apart is probably one of the most responsible central banks. Okay, you need a little bit of irresponsibility among central banks to allow that liquidity gush that will allow for multiples to expand to 30, 50, and 60 times. Okay, so in my view, that's not going to happen in India. So we have to accept these factors. So my view, we may have good times for the markets, but the best days are behind. That 15, 16% 5-year CAGR, etc., is behind. So 2019 to 25, those were the best days of our lives as far as markets is concerned. Fine. So, of course, this also I'm talking in terms of probabilities. Nothing is certain for sure. I mean, what if AI comes and makes some massive productivity improvements, profits increase substantially? But all that to me is building castles in the air. It's possible, but that is, you should not be investing based on those assumptions. Fine. So this is as far as markets, not cheap for sure, and will grow in sync with earnings growth from here. Now let's move on to the other thing that has been catching everyone's fancy, gold. Something at BL Portfolio, we've been very positive on gold. If you've been reading our articles over the last 2-3 years, since the Russia-Ukraine war started in February 2022, we've been consistently saying buy gold, increase allocation to gold. So yes, see, this is JP Morgan, okay, the founder of the world's largest investment bank and one of the largest banks. He said gold is money, everything else is credit. Till 1971, the US had a gold standard, a fractional gold reserve standard, where the dollars in circulation were linked to gold, and global currencies accordingly traded. Okay, so the dollar was a very strong currency because it was backed by gold, and global other countries currency would trade in sync to their economic performance versus the US economy. The dollar was the benchmark for currencies, and when other countries exported to the US and got dollars, if they wanted, they could give the dollar back to the US and say, give me gold. Okay. So in 1971, US put an end to it. Richard Nixon as president basically said, we are not going to do this. Dollar will be a fiat currency. All right. So then it traded only according to the strength of economy, the circulation of money, geopolitics, etc. These are the factors that influence the US dollar. This resulted in a massive preference to gold in the 1970s. Okay, so in the 1970s, if you see, gold was up by 1,475%. Can you imagine? On a 10-year period, it went up over 14 times. All right. S&P 500 was up 47%. I mean, you did not even beat interest rates at that with that kind of a performance. I have this gold in INR. Let me tell you, the data we have in Bloomberg gives gold data in India only from early 2000s. So what I've done here is I've taken the gold international rate and converted into the USD INR rate over this period. Okay, so largely that should be the gold price in India. Global gold price into the USD INR should be the gold price in India. The only reason it will change is when government increases duty on gold or decreases duty on gold. This will have the impact of increasing or reducing the price of gold according to the duty change in India. So for our analysis, this works. Okay, and I've compared this over the last 2 decades. This matches the INR MCX gold rate. Okay, so the gold in India would have been up by a little over due to a little bit of depreciation in the currency, and dollar index was down 25%. Okay, 25% move in the dollar index is quite significant, but you can't even see it in the chart because gold had such a significant outperformance. So the defining factors: Nixon shock, which is going off the gold standard, a decade of stagflation. Okay, US, UK, and many other Western economies endured a terrible, torrid economy in the 1970s. Low growth, high inflation. Okay, so that was so people's purchasing power was getting substantially eroded, and neither were they getting good jobs to keep up with the increase in cost of goods and services. So decade of stagflation. So people are losing faith in fiat currency. Federal Reserve missteps. Under Arthur Burns was the Federal Reserve chair in the early 1970s. He increased interest rates to quell inflation. Then under pressure from government, like what is happening with Trump and Jerome Powell, although the fight was not so brazen, but under pressure from the government, he lowered interest rates before inflation was fully under control. Inflation started again rising from 74, 75. Then you had Middle East conflicts, Arab-Israel wars, early part of the 70s, oil embargo. So one thing is that fiat currency excess supply creating inflation. Then you had supply side shocks, like we had COVID supply side shocks, oil embargo, Iran revolution. All these factors resulted in a massive thrust for gold to move up. Okay, so this was that decade. The 1980s, the tables turned a bit. Okay, gold, if you see, fell substantially in this decade, and uh, S&P was up. Gold in INR was also up, and dollar index was down. So normally gold movement is inversely correlated with dollar index, because gold is measured in, when we say USD, gold is so and so USD per ounce, etc. It is measured in dollars. So when overall, when people's perception of the dollar decreases, automatically gold should increase. But this was a decade where dollar index declined and gold also declined. Although dollar, so I'll tell you what happened here was basically the most important event in this decade from a macroeconomic point of view was the Walker shock. Okay, so after Arthur Burns and Fed missteps, Paul Walker took over as the Federal Reserve Chair in late 70s. He too tried increasing interest rates, reducing, but inflation was not coming down on a sustainable basis. So in 1981, he gave to the system what is known as the Walker shock. He increased interest rates to 20%. Like, to give you a perspective, today the Fed funds rate is 4 to 4.25%. That was 20% in 1981. That is where Paul Walker took it. And that was in the middle of 1981, that was 10% above the inflation. So for example, so that was 10% above the inflation. Okay, so massive shock for anyone, for the economy. Okay, I mean, how do you borrow at 20% interest rates and do business or personal consumption? But Walker did it because he knew it would bring about a recession, but he knew that would ultimately convince public that inflation is done with, inflation is vanquished. What was causing, one of the factors driving inflation continuously from mid 70s to early 80s was that people lost faith that central banks will control inflation, because years you live with it, you tend to accept that as the norm. Like, we have 15% growth in the last 5 years in Nifty. Many will assume that the next 5 years will also be 15%, but that is not the way things play out. Okay, so this is what happened, and so Walker was ready to give a shock to the system to fix it, a short-term pain for long-term good, and that did happen. The 1980s to 2000 was a glorious decade for the US. Great technological advancements, good economic growth, massive thrust to standards of living, etc. So Walker shock, inflation vanquished, public confidence restored, yet dollar index went down. The reason is this: it wasn't due to any macroeconomic economic factors. It was due to what is known as the Plaza Accord, which in the mid 86 or 87, with the US signed with some of the Western countries. So the dollar, after Paul Walker's success, the dollar index, people got confidence in the dollar, and dollar index went up. This resulted in kind of a problem that Trump is fighting today, which is that US exports plummeted while US imports increased, simply because dollar is when dollar is expensive, it is cheaper for Americans to import from rest of the world, and it is difficult for rest of the world to buy US exports. All right, so but at that time, US wanted to play by the global norms. They did not want to enforce tariffs, which Trump is doing today. The belief in free markets, anti-tariff mood was very, very strong. US wanted to be the beacon of free market. It was Cold War time also, so they were fighting for democracy, free markets, etc. At least superficially. Okay, so the US negotiated an agreement with Japan and few other Western countries like Germany in the Plaza Accord that they will have to allow their currencies to appreciate against the dollar. They wanted the dollar index to reduce. With the threat that if that does not happen, they will enforce tariffs. So other countries and their central banks implemented steps that resulted in their currencies increasing against the dollar, and hence the decline in dollar index, not due to how economies were functioning. All right, this is something I wanted to explain. Normally, the correlation will be inverse. That is changing now in the 2020. That also I'll come to in one of the later slides. So this was the 90s. Okay, totally a dull year for gold. S&P 500 was up 3%, 300%. Gold in INR was up because of rupee depreciation. BSE Sensex up to 82%, liberalization, massive growth in India, big changes, right? So in my view, from a government budget point of view, budget or policy making point of view, not just budget. I believe liberalization was number one, the biggest thing in 91. Then the corporate tax cuts of September 2019. Everything else, many other reforms have happened, GST, etc. But from a market point of view, if you will have to rank it, I would rank it in this way. Others could differ. Somebody would rate something else higher than corporate tax cuts, but I believe that was very significant in 2019. So technology revolution, .com revolution. So AI today, .com then. And yes, most important, Bill Clinton actually balanced the budget and brought it to a surplus. US went from a fiscal deficit to a fiscal surplus. Can you imagine? So today they're running 6-7% deficit continuously without any care for the consequences of it. Bill Clinton balanced the budget. So when that happens, people's confidence in the currency is restored. Inflation is under control. Good time for markets to kind of businesses to invest, grow, and good for markets to reflect that. Okay, so this was the 1990s, 2000s. Gold back after 2 decades of lull. Gold was back in focus. A lost decade for US markets. Look at S&P 500. It was actually down 5% through the decade. Imagine being invested in the markets for 10 years and you've lost 5% of your wealth. That was that decade for US stocks. Gold in INR up by 400%. Great time for Nifty. Indian economy, we had 8-9% growth in some of the years during the decade. We were all the markets fell in 2008. Our economy was very, very resilient in that year. So our GDP growth declined, but still we had very decent GDP growth. While rest of the world was going through a turmoil. Dollar index declined. Now, so what were the factors that resulted in this? .com bust starting in 2000. Then start of easy era money to revive economy from easy money era, to revive economy after the .com bubble burst. Alan Greenspan, Fed president, reduced interest rates, wanted money to flow freely so that the liquidity will pull the economy from a mild recession that was playing out in 2001. That resulted in housing bubble, reckless lending because cost of funds was cheap, and then regulations were also reduced, resulting in no proper oversight on loans being made. All that resulted in dollar losing some value. Then came the housing global financial crisis and the housing bust. Start of the QE experiment. Till then, QE was largely in theory. There are some people, central banks used to pump in money, but mildly. 2008 is when it became a massive experiment across global Western banks to deal with the impacts of housing bubble, which was crushing people's confidence, people and business confidence in economy. Okay, and the U.S. government was back to budget deficits. So all these again, uh, gold got into favor. 2011 to 2020, right? This too was an era of massive easy money, but gold was up only 34%. I will tell you why. So there was a tech boom, which resulted in, which was good for stocks, and interest rates were low, which is also good for stocks. Eurozone crisis, one reason that contributed to low interest rates. Uh, the most important factor you have to keep in mind that happened in that decade, which kind of puzzled value investors, economists across the board, a period of confoundingly low inflation. Central banks were pumping in money, uh, governments were spending, but inflation was still low, 1%, 1.5%. US Fed had a target of 2%. It wasn't going to that level. Central banks want inflation because once some level of inflation is good for the economy, because some increase in prices uh, uh, is required. Okay, for because that is what will keep the economy going. If you do not have increase in prices, if you have decline in prices, what will happen is people will stop their purchasing decision. Like you want to buy a car at 100, let's say, I'm just giving it for the sake of example, at 100 rupees today. Okay, uh, you will buy it today only if you believe it will be 102 rupees tomorrow. You will think that you can save 2 rupees by postponing your decision by 1 year. uh, but if you believe the car will be 98 rupees in 6 months time, you will not buy it today, which is what happened during the GST cuts in September. What happens when as a cohort all consumers delay purchasing decisions? uh, Economy will slump. People won't buy, business won't happen. That itself will become a factor that is driving economies down. So central bank wants some inflation, mild. They just don't want it to be too high. So US Fed was targeting 2% inflation. The other reason they were targeting inflation, the inflation is if inflation goes up a little bit, you can increase interest rates. During a crisis, you can reduce interest rates to pump up the economy. So these are factors why there is inflation targeting. In case you're wondering why there is an inflation target, whether it is the RBI or whether it is global central banks. Okay, so that was a period of confoundingly low inflation. So much of money, liquidity gush, economies were growing, pretty decent growth through the decade. Eurozone crisis was kind of settled by in 2013-14. Uh, Still, inflation was low. Many reasons. People say it's technological innovations, exports from China, etc. So confoundingly low interest inflation, as a result of which gold did okay, but not great, despite the liquidity gush. Now, 2020s, right? So, what are the defining factors? COVID came in 2020, then fiscal profligacy, spend nothing, modern monetary theory. You can print as much as you want, nothing will happen. Those kind of irresponsible economic theories started playing out early part of this decade. Monetary policy failures across the world, except India, right? Among major central banks across the world, US, European Central Bank, Bank of England. Everybody said inflation is transitory. They had egg on their face. Our central bank was the only central bank that managed to keep inflation in check reasonably. Fiscal deficit of the government also. We have a government that is uh, actually after the COVID stimulus, they were clear that they're going to reduce fiscal deficit, and the COVID stimulus was also so targeted. Unlike in developed economies where money was just given and printed and given to everyone, we had more responsible fiscal policy and monetary policy. So rest of the world uh, was spending too much. Then now we have the AI bubble. geopolitical risks at the highest level in the post-Cold War era. Okay, so yes, this I forgot to mention when I was talking about the 90s. One of the reasons why gold did badly, among other factors, is the greatest geopolitical threat of the 40, 50 decades till that time was done with. Okay, was done with. Russia collapsed, USSR collapsed. There is no Cold War came to an end. Geopolitical risk subsided. Okay, so now what is happening here is we are having the highest geopolitical risks since the Cold War, end of the Cold War era. It's not a small thing. It's not as bad as the Cold War, where they say that there will be people with presidents could could what do you call, pause or press buttons at any point of time, nuclear buttons, kind of a thing. It's not that bad, but it is quite bad. All right, you could say relatively it's not that bad, but from what at least the period that I have lived through, I feel this is one of the most risky periods at a global level. From the geopolitical standpoint of view, China, they wanting to integrate Taiwan, etc. All these are risks. Okay, so now you have tariff wars also, and again, after 5 years of 4 years of high inflation, public is beginning to lose confidence again on price stability, like it happened in the 70s. So that is the problem we are having now. So in many ways, this decade 2020, where we are in, looks similar to the 1970s. So when we talk of gold, we should refer a lot to the past decades. I wanted to run you through these slides to explain what are the factors that will drive the price of gold. Okay, geopolitical risks, irresponsible central banking and fiscal policy, uh, and then you also have this thing. You will also have what do you call it? Uncertainty on the economy. All these are safe haven, which is when people go to gold. Okay, all those factors are in place today, and which is why gold has had a great run. I will come to what is our take. Okay, uh, before that, I wanted to show you something. At BL Portfolio, we have been recommending investors to consider gold, increase allocation to gold since the start of the Russia-Ukraine war and even before. But we've been writing on it more frequently. I would like to take your attention to one specific article we wrote in last year, March. Okay, this was authored by me and my colleague Akhil. And so, if you see this, right, uh, at this time when we published this, gold at a global level in dollar terms had reached an all-time high. We explained some of the history of gold, factors that drive the price of gold, and we also used the gold Nifty ratio to explain why gold will continue to do well. Okay, so gold was around dollar 2,200 an ounce then. Today it's around $4,200. You can see how gold has significantly outperformed other indices since this article. The structural factors that we explained at that time are still in play. But yes, after this upside, you can say a decent or a significant part of the upside is done with. But then we have another 4 5 years of let's say you're an investor today, you will want to know what can happen over the next 4 5 years. So here is what I think can happen when it comes to gold. Uh, Structural factors in play, market valuations are high, uh, global central banks and the governments remain irresponsible. So I see an environment where the risk to gold declining significantly is very limited, while I see the risks to markets declining significantly is higher. So I see an environment over the next few years where gold will actually outperform equities. All right. If equities go up, gold will go up more. If equities go down, gold will go down lower. So this is the environment. So on a relative basis, gold stands better placed than equities, is my perspective. Okay. So here is some more data about on how US debt to GDP has increased 33% in 1970s, 127% today. Look at their average fiscal deficit, which shows government irresponsible government spending. In the 1990s, it was negative 1.9% fiscal deficit. To in this decade, it's minus 6.9%, and you can see how gold has trended when you look at these numbers. This is just the US. This is a story across France, UK, Japan, etc. So not just the US, many of the Western economies are spending too much. This is the size of the US Fed balance sheet. If you see till 2000, the line is very marginally upward sloping till 2007. Then you can see how it has increased. The Fed has been reducing its balance sheet since 2022 beginning, but it is not. It is still way above what it was before. So that much of money is out there, and what is happening is when this money is out there, the money is chasing something. That money, to some extent, is chasing gold as a preferred option in the current scenario. So now I just want to play this video for you. This is just a sec. I will see if I can. Well, like, sorry, folks. It appears screen sharing is not enabled on this app. Actually, wanted to play a video from The Last Samurai. If you go to YouTube and search Last Samurai, and they are not ready. Okay, this is the search you'll have to do. Last Samurai, they are not ready. It's a nice 2-minute video on this thing on from part of the movie. And so there is a scene where Tom Cruise is actually recruited by the Japanese Imperial Japan to fight the samurais who mounted a rebellion against some of the government. Okay, they also are in favor of the king, but they're against parts of the government entities that are modernizing Japan. They believe that the modernization will result in Japanese culture declining. So although although both sides support the emperor, they're fighting amongst each other. So the side that wants to modernize recruits Tom Cruise to train the Japanese soldiers. And in one scene, when he's ordered to go and take them out to fight the war, he says that the Japanese soldiers are not ready, and he proves why they are not ready in the scene. When he's questioned on the fact that samurais fight with swords, bows, and arrows, whereas the Japanese soldiers have guns, he makes a very important point. He says that the sole purpose of the samurai over the last sole occupation of the samurai over the last 1,000 years has been war. So you can have modern equipment, but you may not be able to beat somebody whose sole occupation for thousands of years has been something. Okay, so the same thing is what I want to explain on gold. Today you will have so many people coming and saying a number of things. Gold is overvalued. There's no clear way to value gold. Okay, you have to look at structural factors and identify where it is headed. Okay, there's no clear way to value markets. Also, we can all pick our way. One can do a value fundamental valuation, another can do relative valuation. Same thing applies to gold also. So when somebody comes and tells you gold is overvalued, ask them how and why. It could be, but ask them how and why, and look at analyze the reasons based on that. Okay, that is one thing. Then the other thing I want to bring your attention to is look at the last. If you look at the earlier charts, right, which I'm just going to show to you. So Jan 21 till date. Okay, Nifty 50 is up 85%, while gold is up 162%. How many people actually came and told you, like how many in the markets, fund managers or what do you call advisors said gold is going to do very well? So if you see, most were still selling equities. There were people who were recommending gold, but the focus was still on equities. Okay, so these are factors. When you are investing your money, you should not go with current trends. You should go with what is likely to happen 3 years down the line, 4 years down the line. So keep that same perspective in mind while you are making your investment decisions today, not what is happening. Don't go with some are targets 30,000, some are target 27,000 and all that. Okay, once you have this clear in your mind, you'll be able to make better investment decisions. Finally, let me also say the purpose of this press webinar is to uh, give you a perspective. I don't want to suggest anything on what you should do. I want to give you perspectives and guidance on what you can do. Okay, so I'm done with my presentation. Please go ahead with your questions. So why are FIIs continuously selling Indian equities? I explained it to you. Global bonds are much more attractive. Indian valuations are not cheap. So I think you have your answers. Next is to invest in gold now, when to get in. And so is FOMO a good reason to invest in gold now? And when to get in and get out without risks? Wish all AI models can. Yes, everybody. And you can't believe what we go through in our profession. We try to get ready for the print edition late night every day, and then Trump suddenly, just as we are readying our edition, Trump tweets something and we have to rework. No, one of the most affected industries because of uh, Trump as U.S. president is the media industry. He gives us sleepless nights. We have to analyze at portfolio. We have to keep factoring many of the things he says when we give you insights on stocks, mutual funds, etc. On FOMO, see, this is what I will see on whether it's a good time to. FOMO must always be rejected. Okay, have zero FOMO in your life. Look out 4 to 5 years from now, how much money you can spare. Uh, on that basis, I have given you these perspectives, right? I've told you what is happening and all that. And then you make your analysis on what you think is going to happen. Based on what I feel, I believe gold will outperform equities. This is only a perspective, nothing is a certainty. But based on the data I see, the way this decade is trending, gold will outperform equities if you're taking a 4 or 5 period. Of course, it depends. Let's say if there is a big correction in stocks, then there will be a time in the middle of this phase when you will have equity, from which point equities can start outperforming gold. So all these things you'll have to factor. See, this is something I also have been in the market for 18 years now, 18 years, and something I've learned the very hard way, which everyone learns only the hard way. You think a crash is going to come and it will come 2 3 years after you think. Okay, so the point I would like to make is that I wrote an article 2 years back, when to sell stocks. Okay, uh, your relationship with the markets should not be based on where the market is headed. It should be based on where you and your life and your family is headed. Okay, what is your financial goal? The money in the markets, can you de-risk by selling some? And let us say, for example, you're saving for your child's education. uh, let's say you started when your child was 1 year old and your child is 10 years old. You've made amazing money in the markets, and the child's education, you'll have to shell out the money at 18. By selling some of this money and shifting to fixed income, gold, etc., whether you will have more certainty that you will achieve that financial goal. That is one way. So buying and selling all has to be based on your circumstances, your financial, which is why I see every financial advisor struggles to give a one fit all advice. Okay, everything depends on your circumstance, your nature, your ability to withstand volatility. So only you will have to assess all these things and make your call. In general, I would say, so I've written this article on when to, if any of you mail to bl.portfolio, bl.portfolio at thehindu.co.in. Okay, make a note of it, bl.portfolio at thehindu.co.in. I can mail back that article to you and you can ask me questions further based on that. Yeah. This question we've already answered. What is the percentage of cash you would advise to hold now? Again, it depends on your situation. Uh, uh, So I will put it this way, okay? Uh, uh, you invest what you don't care about. I mean, you're not worried too much for the next 5 to 10 years. Uh, so that is one part of it. The other part is I don't want to give you what is the cash you should hold, but if you made money in the markets, you can increase your cash levels. It's fine. See, you got 15.5% CAGR over the last 5 6 years. That's substantial returns. Increase your cash levels. Global central banks are now saying go big into gold. I feel that also you should do it gradually. Now, when I wrote that article in March 2024, gold was $2,200. Today it's $4,200. The same structural factors still exist. But obviously, there's a difference between buying at 2,200 and buying at 4,200. Okay, so you can go into gold, but now it has to be more gradual. There will be corrections because now there is a lot of speculative element in gold also. So there will be correction, maybe corrections you can use to buy in. Morgan Stanley a few weeks back recommend early. They were always recommending a 60%. This is global for US investors. Earlier they were recommending 60% in gold and 40% in debt. Now they're recommending 60% in equities. I'm correcting myself. Earlier they recommended 60% in equities and 40% in debt. Now they're recommending 60% in equities, 20% in debt, and 20% in gold. JP Morgan says by 28 gold can be 8,000. See, all these targets will be coming. Increase is fine to increase cash levels when you're sitting on good profits. And I would say increase. I have no answer to what should be the percentage. That only you have to decide based on your life and family circumstances. Okay, increase is the trend. I can tell you, increase cash levels, make use of volatility to buy the right asset. So this question we've seen. Sir. $220.29 is so far away. See, if you are a 15-year investor, you have to look past who is going to win elections and all that, because ultimately, whoever comes, ultimately economies grow, earnings grow. There are stocks that did well in the UPA era, even though the economy was not doing that well. Inflation was terribly high. We had even double-digit inflation for a few months in the early part of previous decade. But still, FMCG stocks like HUL did well, right? So you'll 229. I have no clue how markets will react to BJP at that time. Depends on what are the factors running up to 2029. If you are a long-term investor, you can you don't have to see the election as a big risk. Okay, there are bigger risks in my view. The geopolitical risks are underappreciated. China, Taiwan, Russia, Ukraine is not that severe, but see what is happening. Basically, countries are becoming more belligerent. Earlier, the US also used to be what do you call under earlier presidents like Bill Clinton, etc., even George Bush, whichever party, the way they talk and approach other countries wouldn't be this belligerent. I mean, what can be more silly than Trump actually putting 50% tariffs on India, a country which is one of the strongest geopolitical allies of the country? Okay, so things aren't the same they were 5 6 years back. Can they get back to normal is a call that you will have to take. But the geopolitical risks are higher than before, and they are underappreciated. Multi-asset fund and how much percentage investors? Yes, multi-asset funds are a good way to go. We recently published in our Diwali edition last week on multi-asset fund, and that's better in my view because the fund manager takes over the headache of how to allocate, factoring all these things. Okay, you have to factor geopolitics, interest rates, currency in circulation, fundamentals. So many things you'll have to take and make a good fund manager. Hopefully, will do the right things. Instead of seeing gold in isolation, I guess they need to see it in tandem. So one is positive. What would it mean? See, if you look at the decadal charts I showed you, right? Good decades for gold or bad decades for equities. Good decade for equities aren't that great of a decade for gold, okay? But that's on a decadal trend. If within this decade there have been micro trends that are played out, there have been few years of both gold and equities doing well. Multiple few years period is there, okay? There are, in fact, 3 weeks back or so, I did a page one story in Business Line, the Sunday edition. If you had read that, you'd have noticed I had mentioned that the best year of gold is followed by an upside year for gold, and equities are also mostly up in that year. So if you're looking at a 1-2 year basis, uh, anything can happen. The decadal trend is this: best years for gold are not good years for equities, and vice versa. Will you advise us to exit stock market and sit on cash? Again, the same question, same answer. Your call. Uh, Everything depends on your personal situation. Yeah. See, this is a very, very interesting question, Biju, Daniel. Fantastic question, I would say. Uh, uh, this is something that many value investors are breaking their head on. Okay, the best fund managers of the 1990s, the value investors, take off Buffett. Okay, Buffett is an exception. He's like Sachin Tendulkar or Don Bradman, who do well under any circumstances, and they have their name etched in history. Many others, very, very successful fund managers of the 80s, 90s, in the US, I'm saying, 2010s, okay? Uh, they've all had a torrid time in since 2009-10. They've underperformed the markets. There are in fund managers like John Hussman who predicted every bubble perfectly, like the 2001 dot-com bubble, 2007 financial crisis. His fund had a tough time in the 2010 to 20 decade. He's a value investor, okay? Uh, the tables got turned a bit due to quantitative easing and uh, fiscal profligacy. Okay, so the tables got turned a bit. So this question, everybody is breaking their head. Should you be done with uh, the old ways of doing? This is my perspective. Okay, when I started in the markets, uh, the drivers of markets were this. Okay, sentiment. I will give you from in the ascending order. Okay, sentiment is important, liquidity is important, uh, fundamentals most important. Okay, so fundamentals on top, liquidity in the middle, and sentiment in the bottom, from a value investing point of view. But what has happened over the last 10 years is sentiment, fundamentals, liquidity. Liquidity is driving everything. The money out there is chasing something. Okay, so should we unlearn the past fundamentals? Uh, I am still biased towards thinking that ultimately fundamentals will win. Just that the last 15 years has been an exceptional year, uh, uh, exceptionally unexceptional. That is what I would categorize the last 10-15 years quantitative easing. As of now, we can see those coming to bite back, right? Interest rates globally are continuing to remain high. When Fed started rising interest rates, originally they said that uh, interest rates will start cutting within a year. No, when Silicon Valley Bank failed, they said they'll start cutting rates. No, they didn't. They increased interest rates after Silicon Valley Bank failed. So it seems inflation is getting a bit more entrenched, and the old fundamentals are coming back to play. This is a tilt I have. We will have to see how things play out. So I gave you my indications of gold. I never work with targets. I feel you should never have targets because then your mind gets fixated. Have analysis, which is better, which is not better, etc., and invest accordingly. Many book recommendations. Intelligent Investor by Benjamin Graham, I believe, is extremely important for every investor to read. Simple, lucid, commonsensical, and then you will realize, you will feel like it will be like you realize uh, investment philosophy should be like gold, doing nothing but still increasing in value. Okay, uh, so he makes investing so simple. You just have to develop the uh, attitude to invest that way. Then another thing I strongly recommend Buffett newsletters from the mid 1970s till mid 2000s. Everything is there on the website. Start from the oldest, 1974, 75. I think that's where the website starts. Read that. These would be my recommendations. Instead of seeing gold or ECA, I guess they seem so one is positive on gold. I think we've answered this question. Last question is that? Okay. I believe this gold price increase is totally irrational. I mean, could you say the last 10% is irrational liquidity? Yes. Speculation? Yes. I believe this gold price increase is extremely rational. If you read that article that I shared in the presentation, Gold and Goldilocks Spot, you have your answers there. Okay. Extremely rational. Uh, when others are irresponsible, uh, gold, uh, the increase in gold price over a period of time will make them responsible. Okay, there is this quote: if central bankers fail to do their jobs, markets will do it for them. If governments fail to do their jobs, markets will do it for them. Okay, so in my view, it's rational. I don't know what is the rational level, but the run that we've seen is justified by the what things have happened. How you are seeing IT sector shaping up in near future, considering the underperformance it has been through in recent times, and how one should look at the sector from investment point of view. Yeah. So see, this is one thing that BL portfolio has had a good track record on. In IT sector, everyone was bullish, right? Every sell side analyst. People had 5,000 price target on TCS 2 3 years back. Okay, in 2021. January, we asked investors to exit TCS. We said the valuation is expensive. The earnings growth do not justify this valuation. When we asked investors to exit, suggested investors to exit it, TCS was 3,300. Today, 4 years later, 4.5 years later, it is below that. We gave exit suggestions on many IT stocks, Infosys, Happiest Minds when it was 1,500, etc. So this was purely based on valuation and looking at the earnings. So there has been this has played out well. Uh, 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 but are they? There has been a massive valuation compression. But are they attractive now? I'm still not convinced because they are in the middle of a disruption. See again that global interest rates are high. That makes Indian low growth Indian companies less attractive for FIIs. You can pay dividends, you can do buybacks, but none of this changes the fundamentals of the business. Okay, so all these are nomenclatures. Buyback, dividends are all return of your shareholder money to the shareholder. Just because you call it a buyback does not make it any, not even remotely more attractive. Okay, the buybacks and dividends, in my view, are like this. There is a difference in the share count and all that, but fundamentally, the difference between buyback is, let us say you have two Almeras in your cupboard. You keep the cash in the upper Almera or down Almera. It makes no difference. Okay. So that is the point I want to make. So don't go in for all these buyback announcements, etc. That is one thing. And then earnings growth is low. AI disruption is huge. From my point, which is in a recent article after TCS wrote its published its results, I said that the shift in strategy is encouraging, but you still need to monitor and see how exactly it is going to play out. They after the correction, substantial valuation froth flushed out, but not attractive in my view. See, invest in stocks only when you find it attractive. Simple. Otherwise, this is something that you learn when you read uh, the Benjamin Graham's book, that Intelligent Investor, which is suggested, and Buffett newsletters. There will always be opportunities for you to invest at attractive valuations. If you are confused, then a long-term SIP. like a 10-year SIP, 15-year SIP, you invest through cycles, can be okay. Is digital gold or physical gold a better option to see? These are all individual choices. ETFs come with your hassle free. You just log into your account and you invest. Physical gold, you have to keep it somewhere. When you're traveling, you have to think where you will keep it, bank lockers, etc. So these are all individual calls. Don't go for digital gold. Recently, I was reading some article that there is a lot of charges associated with it. So I think ETFs are fine. Sovereign gold bonds would have been perfect, but now the government has stopped issuing it. ETFs, physical gold is your call. I mean, if you want to have bars and you think you can keep it safe, it's your call. You and your family members will use jewelry. That's also your call. I am anti-crypto. I believe. I mean, look at the returns, right? I mean, gold has outperformed Bitcoin in the last 1 year. Bitcoin, see when, if you see sometimes the way Bitcoin reacts is funny. Okay, gold goes up when central banks actually are reducing, which is one of the reasons driving gold increases. US reducing interest rates when inflation is still above the target rate. People confidence is eroding. Okay, but many of the days when you see Bitcoin, when this thing, what is it? When it kind of follows the stocks. Okay, like what is good for stocks is good for Bitcoin. It is behaving like a risk-on asset. Gold too has gone up in sync with stocks, but the reasons are different. But if you see cryptos going up, they seem to go for reasons similar to stocks rather than similar to gold. I am not personally, I'm not convinced about cryptos. Gold has done well, and I believe it makes more sense than cryptos. Or mid caps and small caps, long term bets. They are very, very expensive. Before this presentation, like I analyzed Nifty, I analyzed Nifty all cap index, okay, which is that 750 companies that are listed and form part of that index. Out of that, around 500 companies are existing from FY19 till today. All right. Out of these 500, so when you compare these 500 companies over these 6.5 year period, the valuation has gone up from 23 times to 28 times P. Okay. So valuation is much higher. Margin expansion has been lower than Nifty. The margin expansion has been around 2%. So out of which 1% you can attribute it to corporate tax cuts. So they face more competition. They face more margin pressures. They are mid caps and small caps are expensive. We've been saying it. For anyone, I think what we've been, I think if at all you want to do, you should have a 10-year horizon, 7 to 10-year horizon, and do only SIPs, not lump sum buying. That is also your call. Okay. Yeah. So I think we are largely done with the questions. I hope I answered it to your satisfaction. If you want more clarity, mail to bl.portfolio at thehindu.co.in. Thank you so much. Thank you so much for joining. Bye.